Welcome again to my accounting YouTube channel, where I translate technical accounting lessons to a storytelling version sort of. Now, in this episode, we are still going to talk about the accounting for loans receivable. And actually, we have already finished answering a simple illustration, both the measurement and the journal entries. So this set, if you can still remember. Now, it's time to compare this with other alternative solutions, okay? So let's start with the timeline. Now, other authors uses amortization table. So how do we create that? First is that you need to know that the amortization table can have 6 columns or 5 columns or less. But let's make it 6 first, okay? So we have the years column, that's the first one. And then we have the second column, that is for the beginning balance. The third one is for the interest income. And the fourth column is for the interest received. And the fifth is for the difference, which is the discount amortization. So this discount amortization happens only when the net proceeds given is lesser than the principal of the loan, just like what we have in the sample problem. Okay? So if you remembered, the net proceeds is just 4,769,779, this one, versus the 5 million principal. Okay? Now, the last column is for the ending balance of the loan. Now, let's fill this up with amounts after this. So, let's fill these 6 columns with details. Okay? So, the first column is just the year label. So, it started with beginning of year 1 and then until year 4. So, no need to explain that further. Okay? So let's go to the second column. So the second column starts, of course, with the initial balance, which is again principal minus origination cost received from the borrower plus the direct origination cost. And the resultant is again, if you remembered, 4,769,779. Okay? So for other years, the beginning balance is actually the ending balances of the previous year. Okay? So that's how easy the second column is. Now, let's move on to the third column, which is again the interest income column. And the amounts that will be filled in this column is based on effective rate times the beginning balance for the year. And for year 1, that's 11.5% or 0.115 in decimal times 4,769,779, and that's equals 548,525. So again, that's effective rate times the beginning balance for the year. So that formula is also true in the next years. So you need to remember that. So next is we have the column for interest received, which is just nominal rate times the principal, which in our sample problem is 10% or 0.10 times 5 million principal, and we have 500,000. So this 500,000 will also be the interest received in the next years, in year 2 to 4. Now, let's move forward to the fifth column. So the fifth column is again the discount amortized. So another name for this is the unearned interest income amortized for loans receivable. And you will hear more about this unearned interest income as we go along. So the amount here is just the difference of the interest income amounts minus the interest received. And that's it for the fifth column. So what's more interesting is that the amounts here in the fifth column, if added with the beginning balance amounts, will become the ending balance amounts, which is column number 6. Okay? So, that's it. That's how you fill these columns with amounts. And since we did the first year already, let's fill up the next years. Again, the interest received is just the same, 500,000. Now, let's copy this 4,818,304 in this beginning balance in year 2, and then multiply it with 0.115, and we will get 554,105 as the interest income. Minus 500,000 equals 54,105. So that's the discount amortized in year 2. And then add this to the beginning balance, and we will have an ending balance at year 2 of 4,872,409. And then copy that again, and then times it with 11.5% or 0.115, and then minus 500,000, and then you're gonna get 60,327. And then add this to the beginning balance, and we will have 4,932,736. And for the last time, copy this again in the beginning balance, times 0.115 again equals 567,264, and then minus 500,000 equals 67,264, and then for the last time, add this to the beginning balance, and we will have 5 million. So that's the completed amortization table, and that's how you make an amortization table. Now, before we compare the details given by the timeline versus the amortization table, I have to give you reasons why are we studying about amortization table. Even if I already told you that I am in favor of the timeline analysis in the past episodes, if you can still remember. So I'm gonna give you the reasons. Number one is that in your textbooks, you might find that authors usually use amortization table. So this episode is meant for you to understand those textbooks and use your textbook still. Okay? And number two is that I found some questions where the problem presents an amortization table, and then you need to find out if there is something wrong with the amounts in the table. And you can't actually do that. You can't actually check if there is something wrong if you don't know how to make the amortization table, and you don't know how the amortization table works. Okay? Now, let's move on comparing these two. By the way, before we compare again, the number three reason is that to provide you with more options. If you don't like the timeline, you can use the amortization table. Okay? Now, let's move on to comparing these two, this timeline and this amortization table. So actually, these ending and beginning balances in the amortization table can also be provided by the timeline. See? See this? So this is the beginning balance of year 1, and the ending balance of year 1 is this one. And also, this is also the beginning balance of year 2. Okay? Now, how about the interest income? So, the interest income is directly given here in the amortization table. So that's an advantage. But it doesn't mean that the timeline can't provide that information. So actually, this year 1 interest income, so this is just the difference of this 5,318,304 and this 4,769,779. So the year 2 interest income is just the difference of this one and this one, and so on. So the point is, the timeline can also provide for the amounts for interest income, although not directly. Okay? So how about this interest received? Of course, in the timeline, these deductions. So, timeline can also provide for that one. And lastly, we have the discount amortization. So actually, the timeline can also provide for this. Like this discount amortized in year 1. This is just the difference of this 4,818,304 here and this 4,769,779 and so on. So my point is, the timeline and the table can provide the same information if done correctly. Now, since the comparison is done, let me tell you one last thing. Sometimes, in other books, the table has fewer columns. Like this beginning balance column for some books, it's eliminated. So in getting the interest income, the effective rate is multiplied with the previous year's ending balance, which will arrive at the same resulting amount. So don't worry even if the beginning balance column is not there. Okay? And in others, this discount amortization column is eliminated also. So to get the ending balance, they just get the previous year's ending balance plus the interest income minus interest paid, and you'll get the ending balance. So don't be confused, okay? So that's it for the timeline, and it's versus the amortization table. So you can choose whatever you like. So let's cut this video short. So if you learned, please click like, subscribe, comment, and hit the notification bell and select all to be updated on my next videos. So again, thank you. And remember, even though there are no shortcuts in learning some accounting topics, especially the difficult ones, there is always an easy way to understand complicated things, and you need to find it. Again, see you on my next video.